Some of the biggest industry disruptors we know today, like Airbnb and Google, didn't start out as household names. Behind their rise to power was a key financial force: venture capital. In fact, VCs are responsible for billions of dollars in investments each year. In 2023 alone, they invested an estimated $170 billion across more than 15,000 companies in the US. While that sounds significant, it's a notable drop from 2022, when VCs invested approximately $242 billion. Venture capital is a form of financial investment that has helped turn high-potential startups into billion-dollar powerhouses. In other words, they're betting on companies with the belief that these businesses will grow into major corporate giants. Now, we can take that and say we understand venture capital, but if we go behind the curtains and see how it really works and the impact it has on not only the companies it invests in, but also on our culture at large, we start to truly understand both the inner workings and power of venture capital. As always, resources for this video and more educational content are listed below. The venture capital process is built on a calculated risk-reward system. It all starts when accredited investors or limited partners, or LPs, such as high net worth individuals and endowments, invest their money in a venture capital firm or fund. These firms are then managed by general partners, or often referred to as simply GPs, who search for innovative startups that have the potential for massive growth. Once the right opportunity is found, they provide the startup with a financial investment in exchange for equity in the company. Now, they don't just give someone money and never touch the company they now own. Rather, with the newly invested money and ownership, VC firms often offer strategic guidance, mentorship, and connections to help these companies scale and have a higher chance of major success. The LPs pay the firm's management fees, which are annually around 2% of the total fund. So for a $100 million fund, the management fee would be $2 million. After a portfolio company gets acquired, the GPs typically get roughly 20% of the profit, called carried interest, or carry for short, that the VC fund made. But there's a catch. Venture capital is a high-risk, high-reward game. Most companies making up a firm's investment portfolio won't make it big, so VC firms spread their investments across multiple startups, hoping that one or more major successes will make up for any losses from other ventures. So, in short, a venture capital firm invests money into startups so these companies can become major players in the market and become so valuable the VC makes its money back with a profit, and there you have it. Now, if you're like us, you may still have questions about VCs, specifically about their history. While venture capital as we know it is relatively new, its roots can be traced back to one unexpected source: the 19th century whaling industry. Some historians argue that the risk-sharing model of whaling is what inspired the foundations of modern VC. Fast forward to 1946, when the first modern venture capital firm, American Research and Development Corporation, or ARDC, was formed. ARDC made waves by investing in companies that capitalized on World War II technology. This firm was led by individuals considered successful by society's standards, like MIT's President Carl Compton, Federal Reserve Bank of Boston President Ralph Flanders, and Harvard professor George Doriot. Before ARDC, only wealthy families like the Rockefellers were taking on the risks that could yield massive returns. But ARDC proved that large institutions, like universities and insurance companies, were willing to take financial risks for the potential of significant rewards, too. Venture capital isn't just about making money, it's a driving force behind technological advancements. VC firms like Andreessen, Horowitz, and Sequoia Capital have poured billions into today's cutting-edge innovations, from the rise of cryptocurrencies to the rapid developments in artificial intelligence. In fact, some of the buzziest companies of 2024, like Perplexity and OpenAI, owe their success to venture capital funding. Without this financial backing, many revolutionary ideas and technologies wouldn't have had the resources to scale. However, the VC industry is subject to market fluctuations. As we mentioned at the beginning of this video, in 2023, venture capital investments in the US dropped from $242 billion in 2022 to $170 billion, with economic uncertainty playing a significant role in the decline. Still, with AI and other emerging industries, the future of venture capital remains bright as it continues to play a strategic and intentional game of high risks and potential high rewards. We've only scratched the surface of venture capital. If you'd like to dive deeper, visit the resources below and subscribe to our channel for more content like this.